Good morning, First of all, I'd like to thank AGIC and GTA for the opportunity to come and talk today. What I'm going to talk about is some trends in Asia, and specifically for the flour milling sector, and then look a bit into the value chain to talk about what the challenges are that are being faced by the millers in Asia. So in terms of the presentation structure, I'll look at macro trends to begin with. We'll look at some import analysis with respect to the flows into Asia, talk about the evolution of flour milling capacity in Asia, and then drill down into the milling value chain and try and identify where Asian millers are going to have to work and differentiate themselves in order to survive. So I think it's not much of a secret, but the axis of the world economy is shifting towards Asia. And if you see from the chart here, by 2030, the Asian middle class will make up more than the rest of the world's middle class put together. So this is why this area of the world is driving the world economy. The first wave of this growth has been associated, of course, with China, India, Indonesia, and now increasingly the nations of Southeast Asia, so the Philippines, Vietnam, and Thailand. And the reason for this is not just this stellar economic growth, but it's also the very high populations that each of these countries has. Now, what this means is that as the income grows in Asia, you have an increased calorific intake, and this is represented whether it's in the milling sector or in the feed sector. And the other interesting factor is that we're still at early stages with respect to the consumption per head by these countries. Because if you look on the graph here, you can see that if you take the States or you take Europe or even the developed Asian countries, they're still a lot further up the curve with respect to consumption per head. And it means that the growth we've seen already is only the beginning of the story. We're going to see a lot more in the years to come. Oops. So what this map does is it gives you a snapshot of what people are buying today and where they're buying it from. And it's still dominated by the traditional players of the US, Australia, and Canada. And I've split the map there into two segments, which is the North Asian countries of Japan, Korea, and Taiwan. And you'll see the line goes around the Philippines, so that's more to do with their buying pattern, which I'll go into. And then the Southeast Asian nations. Now, traditionally, the North Asian markets were taking a larger proportion of their grain from North America. A lot of that's historical legacy, who set up those industries, who's their biggest partners. And the Philippines, even though it's a Southeast Asian nation, its buying pattern more mirrors what goes on in Japan and South Korea versus the rest of Southeast Asia. A lot of Southeast Asia were flour importing nations who didn't have their own milling industry. And in the beginning, they were using a lot of Australian flour. And then if you look at the third sector to the left, we have South Asia, and this is starting to appear larger and quicker on the map with respect to India, Bangladesh, and Sri Lanka, with Bangladesh being the real leader at the moment. Now, they're different to the other two sectors I've shown because they're currently using mainly non-traditional origins, whether that be Russia, Ukraine, or Argentina. But that's kind of setting a pattern for what we're seeing elsewhere. With respect to specific volumes, you've got about 12 or 13 million tons into North Asia, which includes China. You've got probably 16 to 17 million tons going to Southeast Asia, and that Southeast Asian sector I'm including the Philippines. And then you've got 7 to 8 million tons going into South Asia, of which the largest proportion is going to Bangladesh. And then you'll see there's 3 stars in there to where is leading that growth, and that growth is leading in Indonesia, Philippines, and Bangladesh. Now, if we drill down into the specific countries that we're talking about there, you can see on the right-hand end of the scale, we have Indonesia. So after many years, Japan has been displaced as the biggest importer, and it's now Indonesia. This is just the milling wheat side. This is not the feed wheat. But then what you can see as well is the stellar growth in Bangladesh, but we've also seen strong growth in Vietnam, strong growth in the Philippines, and that over on the left you can see where India came in. That was one of their drought years, but we'll get to talk about that a bit more later, as I think that's going to be more and more important. Now, probably of particular interest here is we've seen in the lower protein segment, and it's been talked about a lot, is you could call it flexibility on the part of the buyers. We saw the growth in the last presentation of Black Sea grains. So what you've seen in the flexible markets, or the markets where they've had to look for cheaper solutions, they've been taking more and more of the non-traditional origins, whether that's Russia, Ukraine, or Argentina. For the moment, it's largely around Bangladesh, Indonesia, and a little bit to Malaysia, but I think that's a trend we're going to see increasing. Now, what this map does, it's the same as the one previous, but this is a 2028, 2030 forecast. And what's interesting is you look at North Asia, relatively flat, already high consuming, aging population, lower economic growth. You look at Southeast Asia, and that trend line is increasing. We go from the 15, 16 up to 20, 22 million tons. But then you look at South Asia, which has then gone from a start from 7.8 up to 20 to 24 million tons. It's a game-changing landscape. I mean, what this means is that basically the origins have got to come up with another 20 million tons of wheat supply in what's not much more than 10 years. And that's excluding feed wheat, wheat for energy. We could have another 10 million tons on top of that. And based off current prices, that would all be Black Sea and Argentina. But they're not going to be able to make up for that production deficit, you could call it. So the world is going to have to find more grain for Asia. And I think this is going to change dynamics a lot. And on the graph, you can see I put the Russian and Ukraine flags as bigger. The Argentine flags are bigger because there's going to be a bigger draw coming in here. But I think there's also going to be an increased demand for Australia if more grain can be produced. Now, just focusing in on the milling sector for a moment, if we go back to the beginning of this millennia, we saw relatively, we saw very strong growth in the production capacity in Indonesia and Vietnam, smaller amounts for the Philippines and Malaysia. If we take that to 2010, 2015, Indonesia then took another jump forward. This coincided with the growth in their economy. Growth in their economy, people had more money. People tend to eat more wheat, more meat, and less rice when they have more money. And this trend will continue. And then if we look, what we think is going to happen in the next decade is we'll continue to see, and this is based on talking to the milling engineers and the intentions of customers, is that they are going to continue to keep ahead of the game with respect to milling capacity, and they do tend to anticipate the growth because it takes you, 2-3 years to put up a new milling plant, or if you want to expand, so they have to stay ahead of the game. And then you'll see there's another flag appeared on the map there, and that's with Myanmar, basically being a smallish market, but again, it's opened up, economic growth running 8-9%. So we'll begin to see that. It's not going to be long before Myanmar's exceeding Malaysia or other. So it's a question of people sort of refocusing that the market we used to think is big is now no longer big, and you've got these other markets coming along. And I suppose the good news as far as Australia goes with respect to Myanmar is that currently it's almost a 98% Australian market. But today that's served mainly in containers. The country is opening up. They're building infrastructure. We've got some bulk ports coming up now, so I think that market will move towards bulk. Now, while the millers are staying ahead of the game with respect to building production, what you've had is that as a result of this, the underutilization they're all facing is that flour margins are tight across the region. I mean, they'll always say someone's sort of crying wolf saying, oh no, we're not making any money, but if you do the credit checks on people, you realize the margins are tight and that these guys have got to look anywhere they can to try and earn some margin. So if we look here, what I've got is the sort of three value chains that are associated with a flour miller. We have the inbound flour milling, value chain, which is basically most things associated with procurement. And as the raw material represents probably 75 to 80% of their total costs, the most important thing they need to get right is landing the cheapest grain they can for the products they need to produce. Then there's the actual milling value chain. Most of this is associated with them making sure they've got efficient plants, well designed, and that it's got the capabilities to produce the flours for today and the next 5-10 years. And then the outbound is, again, you're beginning with logistics, but a lot on flour research, customer support, and making sure they're making the products that respond to the market. Now, what I'll do is I'll go into that in a bit more detail. So what I've tried to do here is basically talk about the 4 pillars of differentiation that a flour miller can do. And this is logistics, location and storage, their procurement and risk management, their operational efficiency, and their product differentiation. So starting on logistics, it's now essential for the flour miller to have a proximity to a deep port. Otherwise, he's at a disadvantage with respect to his freight. He needs to have efficient discharge capacity and enough storage to store the vessels they're buying. They need to have suitable scale. I'll talk about this again in a minute, but to the trend that we're seeing towards larger vessels. Proximity to the flour market, and then ideally multi-purpose backhaul for the products, because most of them are received in trucks. So they're always got empty wheat trucks, and people who can do that backhaul logistics are making a difference. From a procurement perspective, they're having to think outside the box compared to where they were 5-10 years ago. They need to have a good understanding of the current drivers of market direction, because often they are selling flour before they bought wheat. So they need to have an understanding of how they're going to do that, because it's not so easy to hedge flour. They now need a deep understanding of the variables impacting landed grain price, whether that's specification, whether that's size of cargo, or other factors. I think it's increasingly important that they have a strong relationship with a number of reliable suppliers, because it's a logistics game today as well. So being able to get your grain when you want it, making sure you don't run out or it turns out too early is very important. Or if there's a finance or there's a quality issue, you need to have someone you know you can talk to. Increasingly, millers now need to understand risk management tools. The use of this is increasing significantly. People are moving away from just buying flat price. They're buying basis. They're buying options to try and manage that risk. They can use risk management if they've got a forward flour contract to lock in a margin when a price level hits a specific point. So that's being done more and more. And then, of course, you need procurement skills outside of just wheat. You're buying energy. You've got labor negotiations. You're buying additives, ingredients. You're buying freight. You're buying logistics. So the suite of tools the procurement person has needs to be much bigger. It now goes without saying that you have to have a modern and efficient mill with the right design. It's got to be efficient in terms of use of energy. You must have in-house technical milling know-how so that you can run that plant properly. It must be a balanced mill that's consistent. And it's essential today that having extensive use of KPIs which can be measured in a real-time basis and are used in remuneration. And then, of course, you need best-in-class preventative maintenance. Now, with respect to products, we've also seen a change in the last 10 years. There's a higher proportion of tailored flours versus generic brands. People have to move much faster with respect to consumer trends. And there's more people producing specialist flours and premixes. Strong food safety is now not a luxury, it's something that must be done. And you must have procedures in place to ensure your ingredient quality. And then a market-appropriate product split so you can supply your customers all of the time. Now, buyers have had to respond to three major changes in the last 10 years. If you go back, basically they had their suite, they had AWB, CWB, and US wheat, and that was pretty much it. And they'd be talking to the same person, one person all the time, and there you go, it was simple. So we had Australia, as I mentioned earlier, we had Australia deregulating in 2008, effectively ending AWB's monopoly on exports and passing that to the bulk handlers and the trade. And what we've seen, as presented earlier, is that production and yields and exports have increased, no question. But it has fundamentally changed the quality drivers, and it's not a secret that this feedback has come from customers. But ultimately, the customers, it's you pay for what you get, and the price signals will trigger the farmer to grow what the market wants. Canada also deregulated in 2012. Also passing control of exports to the bulk handlers, and that has changed there as well. They've also been driven more by yield, and you have had people like China, like Japan, actually complaining in the press about quality, which we haven't probably seen about Australia. So 2 of the 3 core suppliers changed dramatically in the last 10 years. And then the elephant in the room, we've seen the massive growth in the Black Sea and Argentina. You know, these origins, plus the EU, were always there for feed wheat, but that's what it was seen as. It was just wheat for energy. What's happened now is they've improved agronomics. They've improved their ports. You've got international companies there running logistics, risk management. As a result, it's got better in quality, it's got more reliable, and a lot of the millers in Southeast Asia have learned how to use it. So now it is creeping in. I don't think it's ever going backwards. So it's a question of what can be done to handle this. And I think that millers have got no choice today but to use Black Sea wheat and Argentine wheat, because I can't see a dramatic change in flour margins in the time to go. A lot of this is because the return expectation for a family mill in Southeast Asia is completely different to an international business. You know, they may be okay with 2-3% versus, you know, the 8-9% that's expected from an international business. I think this is one of the key changes where the millers have really had to change what they do, and this is respect to logistics. And if you go back 10 years, probably the majority of grain that was purchased was done on handy-sized vessels. That's like sort of 28 to 30,000 tons. What we've seen now is the amount of people who are taking these small vessels virtually disappeared. You've got most of the millers now who are taking Supramax vessels, 50,000, 55,000, and now you're seeing the next step, people are moving towards Panamax, so you're getting 60, 65,000, 70,000. And basically, this is just to, if one person does it, everyone else has, because the difference in freight costs can be huge. I mean, between a Handy and a Panamax, it's probably $30 a ton. But even between a Supramax and a Panamax, you're probably looking at $6 or $8, subject to where the market is. And then those who don't have, you know, the draft, the water depth to handle these big ships, they now look at lightering. So they take it over the side into barges or something like that, so they can still bring in the big ship, because the cost of the additional logistics it's still a gain for them versus the smaller ships. And you're finding that people are building more and more storage now as well. I mean, one of the reasons is to take the bigger ships, but the other reason as well is they like to take advantage of the market. So if they see prices at a 8-year low and we're $30 off the high, they'll say, well, I'm actually going to take more and keep it. Because also, you think about it, most places the cost of money is relatively low, so holding that inventory isn't as much of a cost as it used to be. And then you've got the more sophisticated companies now who've moved from buying, you know, C&F flat, that they're now buying FOB, and they're fixing forward freight themselves. Because generally, if you price forward, you can get the freight better than you can spot, and then they'll either put it together as a C&F or they'll buy FOB and freight. And then a big factor to the millers is they know that freight is still historically cheap. So all these points of differentiation are only going to increase, meaning if they get ahead of the game today, they'll be better positioned for the future. Now, getting to the mill itself, Only best in class is acceptable today. Somebody who doesn't have an efficient mill is basically going to die. If you've got a 2% yield disadvantage versus your customer, you're throwing away $8 a ton. And you just can't do that when the margins are probably 2% at best. So they have to have a best-in-class mill. They can only remove what has to be removed in the cleaning system. I think someone said, yeah, you take out glass and stones and that's about it. If it can be milled, you know, ultimately you have you have some corn or you have some oats or barley gets to your mill. As long as it makes flour and it's not detrimental to product or color, why throw it away? Because you're going to be selling it for a third of the cost of flour. It's essential that the milling system is stable. The customer needs a consistent product. I mean, it's the same for everything, but with flour it's essential because most people are now delivering to automated big plant bakeries or biscuit producers or noodle producers. And if you have a variability in your flour, you're going to have people running around having to adjust machines, which they don't want to do. So a stable flour is absolutely essential. And then the mill needs to be designed in a way that you have real-time, online, measurable KPIs. And you see the dashboard there on the left. This is becoming the norm, so that the mill manager, the CEO, can look at what's happening. And these are generally linked to people's remuneration to make sure that the mill is performing the way they want. I mean, effectively, you're going to sell that flour based on an operating cost that you know and a yield you believe you're achieving. If those two factors vary, the cost of that flour has varied, which they can't have. You've got a lot of people moving towards single wheat processing. In the old days, you'd mix 3 or 4 wheats and you'd make a flour and hope that it was going to come at the quality you wanted. Nowadays, generally, they mill single wheats and they blend the flours so they can make a precise end product. Sounds logical, but it wasn't done before. So, and then, of course, now energy costs across most of Southeast Asia is rising. So the efficient energy use is another point of differentiation. As it's been in Australia and a lot of places for a long time, hygiene is no longer a nicety. It's absolutely essential because you've got lots of multinational, you've got your Mondelez, you've got Nestle, you've got all these people who've got food factories and they expect the same standard that they're getting in the US or Europe or Australia. And then the manpower requirements have dropped significantly. An increase in automation is allowing this to occur. One interesting thing we've seen is that a number of food companies have built mills in recent years. Got a list on the left there. You can see, you know, Bogasari, and Indo Food, Wings, and Mi Sedap, Rubisco, Monde Nice, and MY San. The common misconception is that this was done to reduce the cost of flour. But because of the competitive nature of the flour milling industry in Southeast Asia and the tight margins, most of the time they could buy flour cheaper than they can make it themselves. So ultimately, most of these people did it to control their supply chain and to control their quality. Now, the reason they've been able to have the money to do it is probably, as you can see in the right-hand chart, the best margins are in the B2C sector, i.e. people selling a packaged food into the consumer. So that would be double-digit returns versus straight flour milling, which is, and that's, you know, gross on the side, which is probably well below 10%, it's probably below 5%. So the margin made on those consumer foods allowed people to move backstream. Now, one thing also that the consumer is very conscious of in Asia is that as the middle class grows, the health trends that have been the way of life in Australia, Europe, and the States are going to come more and more into Asia. And the challenge for the flour miller, of course, is he produces a white carbohydrate powder, which is basically seen as the evil empire as far as all the health advice goes. So basically finding ways to, and it's, you know, wholemeal is never going to dominate the market, but we'll expect to see that increase because as you increase the fiber content, you are going to reduce the GI and it's healthier. But a lot of these ingredients I've got on the right are associated with premixes, which is a way of improving the health image of the product and also value adding. And then on the left there, I've just got what we see is the the trends with respect to health and product that we're going to see in the next 5-10 years increasing in Southeast Asia. So whereas before they didn't focus so much on that, the natural and healthy, no pesticide, heavy metals and toxins, mixed flours, whether that be rye, barley, oats, ancient grains, lower GI, low or no sugar, high fiber, other nutrients, low cholesterol, kosher and halal. So these are ways that the miller is going to need to move to respond to the market. And then a few sort of headline trends that we're seeing, which sort of mentioned to a degree, which is that there's definitely low margin across all destinations in Asia. Even though the volume's increasing, the production capacity installation has outstripped that demand. So you've got people fighting for tons. We have seen a degree of rationalization, but it's not done to the point yet where margins have increased. Scattering across the region, you'd say that, you know, the Philippines and Thailand were better. Margins have dropped in the Philippines. They're probably still okay in Thailand, but, you know, Indonesia and Vietnam are a real bloodbath with respect to flour margins. As I mentioned on the previous slide, the integrated players are leading returns. So I suspect, aside from having control of quality and having control of logistics by producing their own flour, in time, the margin moves on the value chain. So owning it now, there may be a time where the margins get a bit better in flour milling. I don't know, but they're positioned for it. And then what we've seen is the local champions going regional. We're seeing people move across the region, you know, Wilmar, Interflour, Malayan Flour Mills, Prima, Pilmico. They've started moving from their single geographies to multiple geographies. One of this is logistics. Another one is the margins move in these countries, and you've got different levels of growth. So I think, you know, that trend probably is going to continue. So in summary, how can the Asian millers win? Where can they value add? What do they need to do to make sure they're going to remain competitive? And that's all around, you know, optimization of the value chain and differentiating. They need to learn how to handle wheat of the season. The knee-jerk reaction of most millers is if they have a problem, they add a specification, not realizing that every specification they add increases the cost. So those smart millers don't increase their specs, they actually reduce them. And on the same light, those who can take advantage of seasonal anomalies to reduce raw material cost. What I mean there is, let's say there's an issue with falling number and there's big discounts available on that grade associated with falling number. The markets that can exude that can do something like debranding to take that off, that actually increases the falling number of the grain. Or if there's a high screenings wheat, or if there's a problem with moisture, those who know how to handle that can take advantage of those discounts, and it's free money for those who know what to do with it. The capability to use and blend lower cost raw materials, those people, the initial reaction, whether it's a lab person in a flour mill or a formulator in a feed mill, when they're asked about a new ingredient, they go, no. You don't blame them, because it's their neck on the line if the product doesn't work. But those who have the right approach to looking at new raw materials, for testing new raw materials, can respond because there's a natural reluctance to do it. And that's what we've seen with the Black Sea wheats going into Indonesia and now into Malaysia. Because if they can save $20, $30 a ton, they're going to have an advantage over their competition. Conversely, some people can do it the other way around. They've got a basic flour that they want to differentiate to their consumers by adding a bit of a special wheat, whether that be a US spring wheat or a prime hard or a soft white wheat, which you probably see to a degree happening in China, which is the basic grist would be largely domestic wheat, then you add a small amount of the imported wheat as a differentiator, and especially in those flours which are higher margin. Higher total or pattern flour yields. Basically, one of the strange anomalies is that, in general, brown flour is more expensive than white flour. But if you look at the logic, if you are getting 83% of the total grain making a brown flour, or 85%, and you're making 75%, that's 8%. And I said to you before, it's $4 a ton additional. So by default, more brown flour means you're making more money. Of course, there's a limit to the market, but it's a no-brainer to do that. And then value-added processing, you've got people now trying to take the step into sort of a B2B area, whether that's with extrusion, flaking, drying, heat, all about value-adding the flours they're producing. And then mixing with other ingredients. It's the norm in Australia, it's the norm in the States that you produce a portion of your flours would go to premixes or concentrates, where you're adding in other ingredients to make life easier for the baker or the processor. That's beginning in Asia now. And then value-added products. Generally, you know, the bran and pollard is normally 1/3 the value of flour. So any way you can do something with the coarse brands, the broad brands, whether that's to someone like Kellogg or whether that's a dried bran or a high fiber bran, any value add to that, you know, is going to, you know, improve your gross margin. And with that, thank you.
Thanks, Will. I'll now ask Andrei Agapi, who is Asia Pacific Agricultural Manager, S&P Global Platts, to join me up on the stage. S&P Global Platts is the world-leading provider of commodity market intelligence and benchmark prices. Andrei oversees, in his role, a multitude of agricultural commodities, including grains, oilseeds, sugar and biofuels. Andrei's experience lies in physical commodity markets, the relationship with complex financial markets and global trade flow dynamics. And Andrei's presentation is on pricing mechanics and competitive landscape for global wheat in Southeast Asia.
Thank you very much. So hello, my name is Andrei, and I'm happy to be here. Thank you very much for the AGIC to giving us the opportunity to speak. So today we heard from a multitude of speakers, particularly on the global outlook of Australian wheat, also on the competition coming from scary places like Soviet Union, former Soviet Union, and S&P Global Platts is an independent benchmark price provider, but I have to disclose that I do come from the former Soviet Union. I'm from Moldova, so thank you for welcoming me here. But I'll be discussing that competitiveness as well, because we do focus on pricing, and we'll probably will be able to shed a bit of light on that. Just a few words to say that we are present not only in agriculture markets. In fact, agriculture is our most recent addition to the portfolio. The company's history is deeply embedded in the energy market with the crude oil, where more than 70% of the world's crude oil trade on Platts provided benchmark prices. But we also are present in metals and the shipping and other energy sectors. Our sister companies are S&P Global Ratings, Dow Jones Indices, and CRISIL. You may be familiar with those as well. So, today I'm going to focus specifically on the Southeast Asian markets. We're going to see where the inelastic demand lies for Australian wheat, where is the elastic markets. Will did quite a thorough presentation on the milling needs, and I will not go into the specific supply and demand scenarios for those, but I will go into pricing. And then we're going to take a look at the competition from Black Sea in the US with a couple of case scenarios. And afterwards, I'm going to briefly touch upon the new Australian Black Sea wheat futures. So on the Southeast Asian market, as we have previously saw, this is quite a big chunk of the international trade market. So it is about 16% of the global wheat trade, at about 28.5 million metric tons in 2017-18 marketing year. Set to grow, but the biggest importers are actually just 4 countries, which is Indonesia, which has overtaken Egypt last year, and Philippines, Vietnam, and Thailand. So those account for about 89 of all the Southeast Asian demand. Major origins for wheat pricing are, of course, Australia, that exports benefits from the proximity to this market, and as well from certain tax advantages into a few of those countries. But what we can see in general that since December 16 on the cash market in Australia, we have an increase in the pricing environment, and the millers have to be careful where they purchase their wheat from, and especially in the context of the competition from the Black Sea region, which you can see with the green line that Black Sea prices are a fair bit less than the Australian prices from WA. So Australian market has to cope with that, and as well as you can see, there's a widening gap with the US wheat market. So as I mentioned, we are experts in pricing and we are independent observers in the market. So this presentation is about opening up our information for your scrutiny, or the data that we see on the market. So it is based on Platts observed data, so it may be incomplete, but what it tells you is quite accurate from what we're hearing on the market. So we'll be looking at those 4 countries, which are Vietnam, Thailand, Indonesia, and Philippines. So what you have plotted here are the deals, the actual trades done of various grades wheat from different origins into Vietnam. And you can see the sort of difference in pricing between all of those. So I've put there in the matrix the average price advantage that some of the origins have over the others. So you can see that feed wheat is about $25.23 more competitive than the APW wheat. Sorry, $23.62 more competitive than ASW wheat, and more competitive by almost $50 than APW. So you can see why some of those markets are finding an outlet, or some of those origins are finding an outlet in the Southeast Asian markets, because the price gap is just that big. So it prompts the buyers to reassess their origins to see how they can benefit, especially in environments of tightening margins. Another factor to look at is so what you have plotted here is also the trend line. In red you have ASW, and in yellow you have feed, and you can see how the red line is slowly departing from the yellow line. It indicates a widening spread between the prices from Black Sea and EU versus Australia. So we started the last marketing year with a spread of about, on average, $13, and we now have arrived to about $46, which is more than three times higher. However, the Vietnamese market keeps on buying Australian wheat, which indicates as well to an inelastic demand and a undisputable advantage of the quality of Australian wheat. Moving on to the Thai imports, it's quite similar to Vietnam in this case, that the purchases are continuing on CFR basis, but you can see the same story there. The spread is widening, not that much as we saw in the Vietnamese market, but the APW Black Sea spread is widening from about $35 per metric ton last year to about $46 per metric ton this year. I know I'm comparing here APW with feed wheat, but it's a good indicator of where the other grades are. So please excuse me, Will, for comparing energy with milling. I know they're quite different. On the Philippine side imports, it is a market that is slightly more sensitive to price discrepancies. So it is in Australia's backyard, and of course Australia benefits not only from a tax advantage but also from a freight advantage versus the Black Sea, because Black Sea is half a world away. But you can see how often the Black Sea wheat deals happen, which are the round circles and squares there versus the crosses in the for Australian wheat, ASW, APW, and H2. So you can see how often those deals happen, and the Philippines buyers through their tenders have figured out a way to put to use the competition from Black Sea to negotiate better prices from Australia, because this is what is happening on a daily basis on every tender. Australia has to be on par, all factors included, with Black Sea. Nonetheless, the spread has widened as well, so Philippines has not been spared. In 2016-17, on average, ASW was trading at about $2 discount to Black Sea when you consider the tax advantage. And this year, we see that there is an increase of about $2. So Philippines market is still paying a premium over for the Australian wheat over the Black Sea wheat, but it's nearly not as high as what we saw in Thailand and in Vietnam. So we don't have the numbers. The S&Ds are not our specialty, but we can say that according to what we hear, the Australian wheat is indeed losing market share in Philippines. Moving on to maybe the most painful, if I could say so, market for Australia at the moment, and it is the Indonesia. So you can see how many deals are happening on CFR into Indonesia versus versus Australia. So Indonesia probably has been the most efficient market in Southeast Asia to switch from Australia to Black Sea when pricing makes sense. So pricing started to make sense about 3 years ago when these imports have become popular, and they have only been ramping up. On average, the spread between ASW and Black Sea wheat is about $9. So Black Sea is $9 cheaper than Australian wheat. Of course, Indonesia cannot import feed wheat because of their regulations on corn, just because they don't want to have anything competing with the corn produced by their farmers locally. So they import the Black Sea 11.5 wheat both for their milling purposes and for feed. So it is a closer comparison, I would say, between the energy wheat market and the milling wheat market. But you can see already how the spread has widened from about $11 per metric ton to about $25 per metric ton between Australian-based or Australian origin wheat and Black Sea origin wheat. And this is why majority of the millers are just switching to Black Sea, adjusting their machinery and making sure that they are much more competitive with their customers on the flour that they are selling. So I'm not sure how reversible this process is. According to what we've heard before, it is going to be quite difficult to reverse that, even if Australia becomes competitive again. At the same time, the sooner it happens, the better it is for the Australian market share, if Australia decides to fight for those markets. Another market that I want to draw attention to is South Korea. It's not strictly in the Southeast Asian demand pool. It is North Asia. However, it is a very big market. It is the third biggest market in North Asia. And what is interesting about that market is that they are importing a lot of wheat, both from from Australia, from the US, and from Black Sea. Although their purposes are very, very defined, very well defined. So they have Black Sea imports, but they are not actually competing with milling wheat imports because this is only to go into their feed complex. These imports are mostly going to be affected by corn prices. So for these purposes, I've looked at the average spread between APW deals and SWW deals into South Korea, and the average spread, the APW wheat is still more expensive than Australian origin wheat. But what is noteworthy as well is the fact that this gap has been increasing. So last year we had about $20 per metric ton gap, and now it is increased by more than 50% to $31. So because of that, because of South Korea is an inelastic demand market, so we cannot say that Australia is losing market share, because it's not. The market share for that 4 million metric ton import market has been pretty stable so far. Nevertheless, it is quite obvious that Australia was not able to benefit from the growth in that demand, which United States was able to capitalize on just because of that pricing, which is much more competitive. I would like to as well briefly touch on the FOB spreads, because this is how the competitiveness is best visible and better noticeable, I would say. So these are the prices that Platts assesses in Western Australia on FOB basis. So these are export prices on APW wheat. We began assessing those in November 2015, so this is where the data comes from. But we can see that this year, since November, the pricing environment has been increasing, with the highest peak happening last year due to the drought, due to the loss of outputs in Australia, where prices have reached about 260 or high 260s dollars per metric ton on the export basis. But this year we are facing, Australia is facing even higher or even lower crop on the domestic market, and deficits in some of its own markets, which will severely impact the export potential of Australia. And therefore, the prices are quite effectively reacting to that. So we can see that currently, so last week, the prices on the export market have increased to just shy of $270 per metric ton on WA for APW wheat. And it's quite an anomaly when we look at the historical trends in the for those past 3 years in Australia, because usually as the crop comes in, the weather damage is assessed, the let's say everything is priced in, and the market moves on to taking positions on the new crop. This year, the positions on the new crop, those Q1 loadings have been very slow, and the price reflects that, is the inability to sell that wheat, and the need to pay a higher price for that on the domestic market. So let's compare it with the Black Sea wheat now, because everything, as we have seen, is competing with each other on a CFR basis. So the Black Sea prices are no exception to these highs that we see in the market. At the moment, so last year we've seen a record crop from the Black Sea in terms of wheat, and this is why it has flooded the international markets, not only in Southeast Asia, but also in North Africa, anywhere where it could find an outlet for its surplus, essentially. And because it could compete on that price, we don't see in the red line there which is measuring last year Black Sea wheat's 12.5 protein price. You don't see that huge spike that you've seen in the Australian wheat. So meaning that, which indicates for Black Sea being much more competitive even for during the new crop loadings, which you have during Q1 every year. This year, however, has been slightly different. So Black Sea as well is facing a decrease in production, which is undoubtedly affecting its pricing. So we see the green line moving up, breaking the trends that we've seen over the past couple of years. So this will, of course, affect the competitiveness of Australian wheat. And this is comparing exactly that, the APW versus the Black Sea wheat spread. So you can see that last year the spread was much higher with the red line there in the chart, meaning that Australian wheat was more than $60 per metric ton more expensive than the Black Sea wheat on a FOB basis. It's slightly lower when you factor in the freight spreads or freight offsets. Nevertheless, this year, despite the huge increase in pricing, because it's happening in both origins, you can see that Australian wheat still has a shot in being competitive into these markets, especially in Southeast Asia. The prices that I've been showing to you are settlement basis for the CME futures. So they are essentially reference prices and benchmark prices. I just want to briefly touch upon those. If you want to trade those futures, they are available on CME with the Australian wheat under the symbol AUW, on the Black Sea under BWF. Those are both export price wheat contracts, meaning that you'll be trading the export prices, not a domestic price. And another particularity is the fact that they are cash settled. So there's no physical delivery at the settlement. Everything is cash settled. So at the end, you'd be comparing the price you entered the position in and the price you are settling versus the actual cash physical market. And this is the difference that one actor will be playing to another. But please visit the CME website for more information on that. As for our information and including what you have seen today in the slides, please go. We are publishing a report daily, which reports on the daily activity of global wheat markets, especially the cash activity, where you can see the bids, offers, and trades on FOB and CFR, and from origins as US, Black Sea, EU, South America, and Australia. That's it for me. Thank you very much.
Andrei, great. Thanks very much. We did allow a bit of fat in these morning sessions for lunch, so we do have some time for some questions. So if we have any, excuse me, please let me know by raising a hand, and we'll get one of the microphones to you. So, Andrei, you talked about the APW wheat futures on the CME. How can growers participate in that market?
So yeah, these are very new contracts. For CME, APW has been launched about 1 year ago, Black Sea about 6 months ago. So these are exports, these are futures markets that represent export values. But the growers can also benefit from that because they will know what is the export price of Australian wheat. So how does it compare with the international market, and what does the international market pay for Australian wheat? So it's a good way to gauge whether the wheat is going to be consumed domestically or exported, right? And it can serve for the grower first and foremost as a reference price. Nevertheless, if the growers want to participate in those, there are a number of cash brokers that are facilitating transactions on those, collecting bids and offers, and it's not only growers, it's domestic traders or pool representative that can participate in that market via the brokers or directly by contacting CME.
Okay, thanks. If you could introduce yourself.
Thanks. Will, a question to you. My job to ask questions next session, but Indonesia, the loss of market share from Australia, would you describe it as complacent about forecast increases in demand and market growth, yet it's quite alarming, the loss of market share, and I know there's particular circumstances in that market that have allowed additional Black Sea demand in the feed side. But should we be worried? I mean, your prediction of growth in that market, it does seem to me that we are losing a significant amount of market share, and there's this assumption that we're going to get it back at some stage.
Yeah, I mean, there's been a combination of reasons, as you say, as to why that Black Sea flow has grown. It looks a lot bigger than it is today because there's a lot of milling wheat going into the feed sector. We'll probably find out over the next few months, as that flow is not economically viable, how much Black Sea wheat is going into milling. I think that for sure, and I guess it also coincides, we've been running on inelastic Australian demand probably for the last 14 months. That's going to be tested again in the next 12 months. So they have no choice but to use Black Sea or even the lower pro-Canadian for now. In response to your question as to is that recoverable, there's a clear economic dynamic basically for those millers. They will, if the Black Sea wheat is $9 to $10 cheaper than ASW, they'll use the Black Sea. There's definitely an inelastic portion of Australian demand, and we're probably at that today. And it's going to depend on the sectoral growth in Indonesia. Is that a colour sensitive or not a colour sensitive sector? Because anything that's colour sensitive, which portion of the market is, they will still need Australian, but people are learning to use it. But I think if ASW's more than $10 more than Black Sea, it's going to continue.
Okay, we might wrap things up here now. Will, Andrei, thank you very much, both of you.